In today's video, we're talking about two Roth accounts that require required minimum distributions. And for some of you, you might be thinking, wait. Roth accounts don't have RMDs. My Roth IRA does not have an RMD, and you'd be correct. But there are two Roth accounts that do have RMDs, and you probably don't want them to have it. Are there ways to fix this? Well, the answer is, we'll talk about it coming up. Hey, this is Mel Stubbs. I'm a financial planner with Christy Capital Management, and we're here to help federal employees plan for their retirement and get their house in order so that they can have the best retirement that's possible for them. One of the things we talk a lot about is tax planning and helping get money into Roth accounts. And just to do a little clarification, a traditional retirement account is money that you invested and you did not pay tax on it yet. It's going to grow, hopefully, and then when you take a distribution, it's taxable at your tax bracket. A Roth account is where you go ahead and pay the taxes now, then you put the money into the account. It grows tax-free, and then at retirement, when you take money out, you don't have to pay taxes. Now for Roth IRAs, there are two rules that you have to abide by, and that's that you have to have the Roth IRA for 5 years, and that you must be over 59 and a half years old when you take the money out. If you follow those two rules, then it's tax-free. One of the main selling points or reasons why you might want to do a Roth account is that you can get the money in there. Hopefully it grows a lot tax-free, and there are no required minimum distributions. No one forces you to take the money out and lose the tax-freeness of the growth. For most people that don't need to spend their money, they don't like required minimum distributions. That's the government's way of forcing you to take a distribution, and it causes you to lose the tax status that you had inside the account. Now for traditional IRA accounts, traditional TSP, they do have required minimum distributions. And from my way of thinking, it's the government's way of getting tax dollars. You've postponed taxes long enough, and they want you to take a distribution and thereby have to pay taxes on it. Now with Roth IRAs, they don't have required minimum distributions on them. My thinking there is that there's no taxes to be paid, so they don't require you to do it. However, there are two accounts that are Roth that do require it. The first one is Roth TSP. If you happen not to be a federal employee, then it would be the Roth 401k inside of your employer's plan. When you reach the age 72, they require you to take a minimum distribution from both the traditional balance and from the Roth balance. Now for most people, they don't want to take a required distribution at all, especially they don't want to take it from the Roth account. So what's the fix to this? The fix would be to move your money outside of the TSP. If you move your money, like your traditional TSP to a traditional IRA, or if you move your Roth to a Roth IRA, then you'd only be required to take a distribution from the traditional IRA and not from the Roth IRA. This simple move alleviates your need to take an RMD from the Roth account. Now they do have a rule within the TSP that if you're over the age of 72 and you're still working, then you don't have to take an RMD from the traditional or the Roth. But if you're retired and you're 72 or over, then you are required to take distributions from both. That's from both the traditional and the Roth. This is easily avoidable. For most people, they don't want to take an RMD, and this is the fix. You move your money outside of the TSP and into an IRA. The traditional goes to traditional IRA, Roth goes to Roth IRA. Problem solved. So what's the second type of an account that requires an RMD on Roth? Well, this would be if you inherit someone's Roth IRA. So are there ways around it? Well, it depends. If you inherit a Roth IRA from your spouse and you put it in an inherited IRA account, you'll be required to take RMDs from it. But if you inherit a Roth IRA from your spouse, you also have the option of rolling it into your personal IRA. Once the money gets into your personal IRA, there are no RMDs. So that's one way around it. If you inherit Roth IRA from your spouse, you may be inclined to actually roll it into your personal Roth IRA for the sole purpose of avoiding RMDs. Now let's say you inherit a Roth IRA from someone that is not your spouse. Then you are required to move it to an inherited Roth IRA, and there will be RMDs from it. With the Secure Act they put in place, they got rid of the Stretch IRA. The Stretch IRA is where you could take a small minimum amount out and basically stretch it up to 30 or 40 years. Now with the new rules of the Secure Act, there is now a 10-year limit. You have to have all of the money out of that inherited Roth IRA or inherited traditional IRA for that matter within 10 years. The IRS came out with new instructions saying that you actually have to take a required minimum amount out each of the first 9 years and then take the entire balance out in year 10. So some people have the opinion, I'm going to take 10 equal payments every year just as long as all the money's out in 10 years. And that may be a good strategy if you're dealing with a traditional IRA. I want 10 equal payments because those payments are taxable. But with Roth IRA, the distributions will not be taxable. So you may not want to take 10 equal payments. So you are required to take out money from inherited accounts, but you do have a little bit of wiggle room. If you don't need the money to fund your lifestyle, then it would make tax sense to take out the minimum amount for 9 straight years, leaving the majority of the balance in the Roth account to take advantage of the Roth tax-freeness, and then take out the full balance in year 10. This lets you take advantage of the Rothiness, so to speak, for as long as possible. So in this scenario, you can't avoid it, but you can use the system to your advantage to stretch it as long as you can, which right now is 10 years. So just in review, Roth RMDs are required from the TSP or your employer-sponsored plan at age 72. The fix to this is to just move the money out of the TSP. The second account that could have RMDs is an inherited Roth IRA. And if you've inherited from your spouse, the fix is to roll it into your personal Roth IRA. This would avoid RMDs. If you inherit money from someone that's not your spouse, that's a Roth IRA, then you are required to take minimum distributions, but you can stretch it up to 10 years. Now, a lot of times when we're having conversations with people about why they may want to work with a financial planner, sometimes it's hard to put into words some of the benefits that we can offer. I'm sure we can help you fill out retirement paperwork because we know a lot of the details of your federal government system. We can help you pick out allocations about how aggressive or conservative you may want your money to be. But one of the biggest reasons why you may want to work with a professional is in the area of things like this when this pops up. When you inherit money, you can see there are differences in how you can handle it. If you inherit it from your spouse, there's different advantages than if you inherit it from just a regular old person. As life throws you curveballs and you're presented with situations, when you're working with a financial advisor that understands all these rules, they can offer you some choices and then offer you their recommendation. Based on your situation, here are your 3 choices that you have. I'd recommend you take this one right here. That's where the helpfulness can come from. You don't have to learn all the tax rules for all the specific situations. You have somebody on your team that knows that. Some people reference it like, we're the CFO of your household and you're the CEO of the household. We pull together the information, give you a recommendation, but ultimately you make the decision. So whether it's inherited money, whether it's taking a large distribution to buy a house, whether it's delaying Social Security and living off distributions from your accounts instead, there are different scenarios that you may want help with. If this type of help is something that interests you and you've got $400,000 or more in your TSP account, please reach out to us. And if you're a federal employee and you want to work with somebody to help you with your financial decisions, but you want to work with somebody that understands your federal system, the bureaucracy that is the federal government is hard to understand, and it's something that if you mess up, it's not easily fixable. If you fill out your paperwork wrong, it's not easily fixable. If you have a general question and you want to call OPM to get an answer, it's not going to be easy. Our specialty is federal employees and federal retirees. This is what we do day in and day out. So if you want help, you're a federal employee, and you're in the right place. Go to ChristyCapital.com, click on Talk to an Advisor, give us some of your information and we'll reach out to you. Call the number on your screen. We'd love to help you in any way we can. My name is Mel Stubbs. Happy planning. We need to do the proper disclaimers. The purpose of this video is not to give specific tax advice or investment advice. We're going over general principles and ideas that can be used, and if used correctly can save and avoid taxes. You're going to want to work with someone personally who knows your situation personally. So seek out advice from an independent financial advisor. This is for educational purposes only. I hope you enjoyed the video.